Brien, thanks for joining me here for a few minutes. Obviously, we've got a lot to talk about in this market. Big picture thoughts first on this tariff announcement and all the chaos we've seen in markets since it came out.
Yeah, the markets were largely primed and not, I guess, over the last couple of days, but the last few weeks or month or so for some kind of a trip up. They were priced for perfection and were likely to trip over something, but I don't know that they expected this kind of a roadblock. It was like not a speed bump, but it's like a 2x4 to the ankles of the markets. Um, and what we're seeing now is the kind of thing we've seen before, and the kind of thing that periodically and seems, and even more often than or happening more often than ever, are these kinds of blowups that the Federal Reserve and easy money policies engender. They blow up bubbles and then they pop and then they blow them up even bigger again. And we can expect that this time. This is a liquidity vacuum, a liquidity event where everything gets sold, where babies are thrown out with the bathwater across the board of all risk assets, as not just investors rush to safety, but they rush to cash to meet margin calls if they have them. And as we've seen in the 2008 great financial crisis, post-COVID, gold serves its role as the ultimate source of liquidity. It's the piggy bank that gets broken for the cash that lies inside, and it's worked again. And it's been interesting though. Gold is not going down as much as other assets,
Yeah.
as you saw today, and it even had a very strong attempt to bounce back almost to the green at one point today before being driven right back down. So I think that shows that powerful undercurrent of buying that we've been seeing over this year and really over the past year, past 12 months, that there's very strong, often price insensitive buying for gold. That implies, central banks, authorities, deep pockets, and in some cases, entities that have been short the metal.
Yeah.
So
I mean,
it,
Brien, yeah. Sorry to interrupt. I just want to point out. I mean, you've been right as rain about the potential for powerful gains in gold and silver. Obviously, last year was a great year for the metals. It's been a great first quarter, even with this short-term blip. I mean, the metals have been on fire. So, what's been driving that, and why should an investor, no matter what they own in stocks and whatever, why should they be considering precious metals still in this environment, in your opinion?
well, for two reasons, and the two primary reasons to invest in gold and silver, frankly, are as insurance, where you protect the purchasing power of the funds, the dollars that you put into the precious metals, and as an investment. If you see the macro picture or arguing for higher metals prices, then you can leverage that through investments. From an insurance standpoint, it doesn't really matter where the price is because you're insuring against something. I mean, you haven't missed the move, in other words, because buying gold, even at these lofty levels, insures your money that you put into gold against something is going to happen, that being the depreciation of that money over the years to come.
Yeah.
And you can be very confident that that's going to happen and probably at an accelerated rate. So you're really just locking in the purchasing power of those dollars that you put into gold and probably gaining some purchasing power as well. From an investment angle, yes, you've missed a tremendous move in gold by buying now, if you're just buying gold as an investment. The good news is that there are a lot of associated investments and leveraged investments that have not moved, that being most prominently mining stocks,
Yeah.
which have barely moved. And we've seen miners' margins expand by $1,000 an ounce over the or more over the past year, and they have yet to do much with that money in terms of buying other smaller companies. And those smaller companies are really what we specialize in Gold Newsletter, and they're starting to move now. So
Yeah.
the opportunity is there. It's, a lot of the risk is gone because you're not waiting for the opportunity to materialize. It's sitting there right in front of us.
Got it. Brien, let's game a couple things out here. I mean, the dollar obviously plunged after this tariff news came out. You've got other countries that were already kind of, de-dollarizing or whatever term you want to use it because they were afraid of sanctions and things like that. Central banks buying gold. How do you think what's happened this week influences sort of that angle, which is one of the forces that's been behind the bull market?
Yeah, I think it confirms and maybe boosts the trend, but I don't think the dollar is going to be replaced as the world reserve currency in any time frame that has any relevance for you and I. Um, that said, who knows what will happen? I mean, these tariffs are pretty extraordinary, and even those who expected that it wasn't all bluff and bluster and something was going to happen, it really, I think, exceeded virtually all expectations. But I really don't think, despite the best efforts of some, I don't think the dollar will lose its status as a reserve currency. But we do have to recognize the trend, and that trend is in place. Uh, Nations around the world are trying to insulate themselves from the dollar and the dollar weaponization, and they've been turning to gold more and more so. Gold as a percentage of international reserves has been rising, and the dollar as a percentage has been falling. They still have a long way to go before those two lines cross, but again, the trend is there. So if you want to bet on one of those two asset classes, I think you clearly want to bet on gold.
Got it. And final question for anybody who may not have seen some of your earlier work. I mean, as we're talking, we're in that sort of, 31 or 3,200, 3,100 range in gold, low 30s in silver. What are you looking for in terms of longer term targets?
Oh God, I'm too smart to say that. If I don't have to put a time frame on it, I would say that if you look at the past three bull markets in gold, if you divide the gold into three major bull markets post 1971, you have early 70s, late 70s, you have the 2000s. And in each of those, gold went up 5.6 times to 8.2 times from the low. If you mark this low as just above $1,000, around 1,050, then you've got anywhere from $6,000 to $8,000 when this trend ends. Now, if you count the 1970s as one bull market, then your upside goes to 25x from the low. So I think it's going to get a whole lot higher. Let's say that. The timing is always the tough part. I don't think it's an ultimate peak that will be reached in months. I think it'll be years. And I think we're at the tail end, the end game of a 45-year strategy or trend of ever easier money. And it's going to get resolved somehow, and I don't think in the favor of fiat currencies.
Well, listen, Brien, again, I know it's been a busy day for you, for all of us. So thank you so much for taking some time out to chat and for talking about the case for precious metals. Appreciate it.
Great. Thanks, Mike. Always a pleasure.